Welcome to Real Estate Radio Live, an informative and engaging podcast discussing everything you need to know about the world of real estate. Your host, Joe Caccera, provides you with insight and guidance on how to buy, sell, finance, and invest in real estate. He also offers real estate tax management strategies, new construction advice, home improvement tips, and much, much more. And now, to guide you around the world of real estate, here's your host and Real Estate Radio Live team leader, Joe Caccera.
Welcome in, Joe Caccera with Real Estate Radio Live. Thank you for those that are tuning in on Facebook and social media. We appreciate that very much. We're going to continue our episode once a week on COVID-19 and how it affects real estate and lending. There's changes that are taking place on a daily basis, actually sometime on an hourly basis. So the goal is to update everyone once a week. We'll have other topics, of course, during the week with some of the other shows we do. But the main objective here with all the different changes going on as it relates to COVID-19, what we'll do is once a week, typically on Tuesday or Wednesday, give everybody an update on how this is affecting real estate and lending. Remember, for more information, you can always go to RERL-1709-How. I want to thank those that continue to download the podcast, follow the show. For 11 years, between live radio and now podcast, we've done over 1,700 shows and get somewhere between 9,000 and 10,000 downloads a month. So we appreciate that very much. And if some of these topics aren't helpful to you, or if you think they may be helpful to others, go ahead and forward them to friends, family, coworkers as well. So this is week number 2 with an update on the lending and real estate as it relates to COVID-19. So let me start with lending and give you a little idea of what's happening in the residential lending market, some of the changes that are taking place, some of the things to be aware of. First and foremost, we're financing 100% in gear. Everything's going well. In other words, financing is an essential business, so we are not shutting down. There's still financing taking place for refinances, for purchases. All that's in full swing and going well. Some of the things that are taking place are delay in appraisals. So some of the appraisals are taking longer than normal, and then some lenders are not. They're actually holding off on appraisals. So you want to make sure that if you're working with a lender that is not actively using appraisals right now, make sure, obviously, that's going to affect your refinance or your purchase for sure. So lending's taking place. Everything's going as normal. On the financing side, again, I'll give you an update on interest rates. Historically, right now, interest rates are pretty low. However, they should be lower. And I mentioned this last week. It's pretty much the same. What we're seeing right now between the volatility in the marketplace and how it's trying to react to this coronavirus, what's happening is on the backside and the back end, the Fed's trying to regulate and slow the process. They're doing a lot of easing. They're pumping a lot of money into mortgage-backed securities, trying to kind of stabilize the market. So between the uncertainty with that and then the lenders' pipelines being jammed up and pretty busy, what's happening is the lenders are artificially raising interest rates temporarily, and we don't know from time to time when they're going to come down. Normally, it's pretty predictable. Normally, when the 10-year yield, which follows the Treasury's 10-year Treasury, what happens is that follows the mortgage securities. We know when the yield goes down, certainly below 1%, that means that's going to trigger lower interest rates. A lot of the money that's flowing from the stock market back into bonds causes interest rates to improve. So that's typically how it works. Unfortunately, right now, because of the volatility in the market, because of the uncertainty, there is no connection between those right now, unfortunately. That's normally how we track the market and how we know interest rates. So give you some perspective. Where the 10-year yield is right now, mortgage rates should be in the low 3s, and maybe you could even argue that it should be in the high 2% range. So here's the recommendation. The rates are all over the place. They're artificially high. I do know and I do believe that they will come back down because they have. So over the last several weeks, what happens is there are moments when the rates come back down to all-time lows, and they could be in the low 3% range. The only way to take advantage of that is to have your paperwork in, be approved, be ready to go. In some cases, the rates are only there for a couple hours. So in order to benefit from that, in order to pull the trigger and take advantage of those interest rates, the only way you could do that is to have your paperwork in, be pre-approved, have the credit pulled, be ready to go. So for those that are out there that want to secure an all-time low interest rate, you could still do it, but whoever you're working with, make sure you get all your documentation in and get it ready in order to take advantage of those rates. It's hard to say when they're going to happen. It could be, my guess is the next 2 to 4 weeks, but even if it comes down, it'll go back up. I think it'll be a roller coaster here for the next 4 to 6 weeks, my guess, until we get a better fix on how this is going to affect the overall market in general. The other thing that's happening in lending financing right now, which is going to have a direct and dramatic effect on a lot of people, is it's getting even more conservative. So a lot of lenders are exiting the space. Some of the lenders aren't funding loans anymore. So you're losing capacity when it comes to lenders. The other thing that's happening is their guidelines are getting more conservative. I'll give you some examples. So a lot of times on some of these programs, you have minimum credit scores that are, let's say, 620. So some of these programs will allow you to finance if you have a minimum credit score as low as 620. That's changing. Now a lot of them programs will say you can't do this loan unless your minimum credit score is 660 or 680. That's just some examples. Loan to values are different. Cash out amount, they're allowing difference. Investment properties are becoming more conservative. This is really a repeat, for those that remember, of 2008 and 2009 when we had the mortgage meltdown. Lending got very, very conservative, and so that's what's happening again. It's getting extremely conservative, and it'll come back around, but it could take several months. My guess is it'll be probably towards the end of the year, maybe in the third or fourth quarter, before we see a lot of this lending capacity come back and some of these guidelines open up and get less conservative, let's say, about the way they're financing right now. So the thing to keep in mind is a lot of lenders are extremely busy right now. A lot of people are hearing, the other thing I want to talk about is a lot of people in the news are hearing about forgiving mortgage payments, forbearance, mortgage relief. You're hearing a lot of different terminologies behind this. So let me try to clear it up for you, because there is quite a bit of confusion. So many of the major banks, Wells Fargo, Chase, B of A, Citi, most of the major banks have set up these programs, and I can't speak for them, of course, but I'm just giving an overview. Have set up programs where if you're struggling financially, if you lost your job or you're not able to make your payment, a lot of them are allowing you to skip up to 3 months of mortgage payments, but it's not free money. What happens is they'll allow you to skip 3 months, but then you have to, at the end of 3 months, those 90 days, you have to start paying that money back. So don't be confused and think, well, gee, the banks are giving me free mortgage payments for a couple of months, because that's not going to happen. What's going to happen is they'll say, let's say you have a $2,000 a month payment. They'll forgive that payment each month for 3 months. So now they've forgiven $6,000 for this example. And now, starting in month 4, you're going to have to start making up that difference of that $6,000. So you're going to have to start increasing your mortgage payment to make up that difference, because they forgave it or let you not make those mortgage payments for 90 days. So everyone's doing things differently, but don't think that they're going to completely forgive it. My guess is they won't do that. So that's one of the things they're doing. The other thing, they're not reporting it to the credit bureaus, which is really important, because most of the time when you're late on your mortgage payment for at least 30 days, they'll report it to the credit bureau. And the reason why you don't want that is once you have a mortgage late on your credit history, it's not good. It's going to stay with you for several years, and it'll cause you you'll be a bad credit risk. And most people aren't going to want to help finance and finance for you if you have mortgage late. So really important, if you work with your lender, then they're allowing you to delay the mortgage payments. Make sure you get something in writing from them, or make sure that they validate that they're not going to report these lates to the credit bureau. These are big companies, and they're working with millions of people, so they're not perfect, and some of these problems could take place, and I've seen it happen before. So make sure, if you're speaking to your lender and you're making arrangements to delay these payments, make sure you get their word that it's not going to be reported to the credit, because that's going to be a tough one to turn around. Even if it does happen, and even if it's not your mistake and someone else's mistake, it's a tough one to correct in a short period of time. So that's the other thing that's taking place. Some people that are getting FHA and VA loans. So if you have government loans, I would call your lender too and find out. In some cases, and again, I don't want to speak for them, many of the lenders will automatically lower your interest rate. Just take the note and change the note and the terms and lower your interest rate. Sometimes that's a lot easier than going through in a complete refinance. That will happen in some cases. So these are all things to know. My recommendation is to get on the phone, call your lender that's on your mortgage payment, and speak to them. I could tell you that it's going to be a nightmare getting through to them. Some cases people are on hold for 4 or 5 hours, and sometimes they have the ability to call you back. So you just have to figure that out and hopefully work it out if it applies to you. Each lender is different. I could tell you if your loan is a jumbo loan, so if it's over $675,000 roughly or more, you're probably going to have more problems with that loan because they're not government sponsored like the Fannie and Freddie loans that most get with loan amounts in the conforming loan levels of $765,000 or below. So keep an eye on that. Make sure, obviously our team here is always here to help. If you need information about that, you can contact us, Joe at RERL-1709-How, or obviously you could also call me at any time, 408-838-9060. So that's kind of a rundown of the lending. I'm going to spend a couple minutes now talking about the real estate side. How is this affecting real estate as it relates to purchase, buying, selling, and that activity? So real estate was just deemed an essential business. Financing was already an essential business. Real estate is now an essential business that's been deemed essential business by Homeland Security. The problem is not every county follows those same guidelines. So I could tell you for those in Silicon Valley, Santa Clara County, San Mateo County, Monterey County they're not in that same jurisdiction. So it's going to be challenging for a while. I'm not going to speak to the real estate terms because I'm not a real estate professional. So I would say contact your real estate company or the agent that you're working with to get the details. But my understanding is what you could do now, the only way real estate agents currently in those particular counties, the only way they could show you a house is if the house has to be vacant. What I mean vacant is not physically vacant. It has to be vacated by the consumer. In other words, no one could currently own, or I should say, no one could currently live in that home. So the home could be vacant or could be staged. In other words, there could be furniture in the house. That's okay. The key is you technically can't show a home in these counties, surrounding counties, unless it's vacant. If someone's living there, technically you can't show the home because of the obvious concern that even if they're not there when they come back, if there's been several people through the house that are concerned about the spreading the virus. So check with your real estate agent and see how that affects you. You can obviously still view homes online, use technology to do that. The 3D video, a lot of that activity is in place. So the other piece of listing your property is a little bit different. I would check with your real estate agent and see how and if that could happen. And again, I think my understanding, don't hold me to this, but my understanding is that if you list the home, it has to be vacant. So you're going to have to make arrangements with your real estate agent and check with them and see how that works and set that up logistically so it could come together and work for you. But each county is different. So as you're listening to this podcast, remember that this is very fluid. This is changing all the time. There's so many things that are changing, sometimes by the hour, sometimes by the day. So it's a really good thing to remember. So if you're thinking about buying, it's a great time to buy. It really is. I know some people would say, no, I'm going to wait. I'm concerned about this. I frankly think it's a great time to buy because you don't have the herd mentality. The reason why is that there's very few people out there buying homes. So there's a good chance that you get a better deal on a home today than you might 6 or 7 months from now when the market comes back in full swing. You're going to be competing against much more people. So I think it's a good time. Now, some people would debate that because they're concerned, and you might well be concerned about if you're losing your job, you don't have income. Obviously, you don't want to go make a commitment on a house if your job is in jeopardy for sure. So that's a different story. But if your job security is strong and you're confident, now's a great time to buy a home. Not only that, because interest rates are all-time lows as well. So great time for that perspective. Check with your real estate agent on each one of these, whether you're buying or selling. And if you need a referral, certainly we have plenty here that we work with, real estate agents that we team up with. If you want some information or feedback, we're always here to do that. We have a team of people that can help you. Also, with all this, let me finish by talking a little bit about some financial kind of housekeeping that everybody should be doing, especially if you're thinking about there's a possibility you're losing your job or you're going to increase liabilities or your income is going to be decreased. So some of the things to look at is credit card debt. If you have credit card debt, try to eliminate that as soon as you can. Maybe try to transfer it to a zero interest rate for a period of time. A lot of these credit cards will allow you to transfer the balance for 0% interest rate for a year, 18 months. That would be a good move right now. If you have a mortgage and you have debt, credit card, maybe a home equity line of credit, student debt, there's another opportunity possibly to refinance, consolidate that debt into one loan and one interest payment. That's another thing to do. One of the other options out there that a lot of people don't understand, but it is a viable option, is borrow against your 401k. If you get into a financial emergency and you have money in your 401k, most people don't know that, you could borrow up to 50% of your balance, and you're in essence just paying yourself back. So if you have $100,000 in your 401k, for example, you could borrow typically up to $50,000 at the terms of the agreement, and then what happens is you just pay yourself back. So that money doesn't come out, you don't get taxed on it, and then you just make monthly payments on that loan from your 401k. It goes right back to the 401k until you satisfy that commitment and pay it back to its full. So there's some opportunities there too. Now someone might say, well, I don't really want to do that because the market is so low, the 401k has come down, but it really doesn't matter because you're not pulling the money out. You're not taking tax consequences. You're not pulling the money and cashing out. You're just borrowing the money on paper. Certainly you have the physical money, but then you're paying it back. So you're not exiting the market. So in that perspective, it's not going to hurt you as bad as obviously if you just automatically cashed out and took that money versus taking a loan. So these are some of the things I would recommend to do. Take a look at if you think you're in jeopardy of losing your job in the next 30, 60, 90 days, you might think about doing a refinance and consolidating some of this debt if it makes sense. Putting yourself, in other words, in a better financial position before you lose your job, before some people are getting reduced hours. Some people are going to part-time. A lot of these things are taking place right now. So those are some of the ideas to take into consideration if, in fact, you're going to have less income coming in, and at the same time, you still have these liabilities you have to pay on a monthly basis. All right, we're going to give you updates each and every week. This is just another update. This is the second one. Each week we'll do an update again on COVID-19 and how it affects real estate and lending. As always, we're here to help. If there's anyone that wants to schedule a phone call for a consultation to talk about ideas on strategies, how to consolidate debt, get a mortgage, all these types of things, feel free to reach out to 408-838-9060, or you could always email joe@reradiolive.com. Thanks again for tuning in. Take care and be safe.
You've been listening to Real Estate Radio Live. For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Subscribe to our podcast. Discover more at RERadiolive.com.